So the proposal in Project 2025 to dismantle the FDIC, OCC, NCUA, and part of the Federal Reserve and consolidate them into a single regulatory agency represents a significant restructuring of the United States financial regulatory system. And while it emphasizes efficiency, financial innovation, and reduced government intervention, this approach raises critical questions about feasibility, risk, and its potential impact on financial stability. So here are some of my thoughts about it. So the pros of this proposed regulatory restructuring, streamlining regulatory oversight. As a former compliance regulatory officer, I think merging multiple agencies could reduce bureaucratic overlap and increase efficiency in regulatory decision making. A single agency might simplify compliance for financial institutions, lowering costs, which is important, and creating clearer rules, which is necessary, and promoting financial innovation, which is a plus, by reducing by reducing activity restrictions on financial institutions. The proposal could allow for greater flexibility and creativity in offering financial products and services. Encouraging competition and market discipline may spur innovation. May spur, right? Consolidating agencies could reduce the size of the government, eliminate redundant functions, and lower operational expenses, eliminating the too big to fail perception, right? So repealing provisions like Title I and Title II of Dodd-Frank aims to end government bailouts and excessive regulations of large institutions, theoretically pushing firms to act more responsibility. Theoretically, privatizing housing finance, Fannie Mae and Freddie Mac would shift housing finance risks away from taxpayers to private investors, potentially creating a more sustainable mortgage market. Maybe. The cons of the proposed regulatory restriction: lacks of checks and balances. As long as they privatize and get their money, they don't care, right? But consolidating power into a single agency removes institutional checks and balances that help to ensure regulatory accountability and prevent abuse of power. The merged agency would have immense authority, creating the potential for regulatory capture or policy decisions favoring powerful financial institutions. The erosion of specialized oversight. Agencies like the FDIC and the NCUA have distinct mandates, ensuring deposits and protecting credit union members. Consolidation risks diluting these specialized functions and their consumer protections, especially because the credit union and the banks they operate differently. Expertise in niche areas, credit union operations, or deposit insurance, they might be lost in generalized structure, like they might start to look the same. Systemic risk and instability. Removing activity restrictions could increase systemic risk by allowing financial institutions to combine commercial and investment banking, potentially repeating the pre 2008 practices that contributed to the financial crisis. Market discipline alone might fail to adequately mitigate risk, especially during periods of economic uncertainty. Now, the impact on the consumer confidence is important. Let's talk about it. Dismantling the FDIC, which insures deposits up to $250,000, could undermine public trust in the banking system, leading to deposit outflows or bank runs. People gonna pull their money out the bank. Similarly, removing the NCUA could destabilize credit unions, often seen as safer, community focused alternatives to traditional banks. The repeal of the Dodd Frank provisions. While Dodd Frank has been criticized for its complexities, provisions like orderly liquidation authority are designed to manage failures of large institutions in a way that avoids broader crises. And removing these tools could leave the financial system vulnerable in the event of future crises. Privatization risks in housing finance. While privatizing Fannie Mae and Freddie Mac may reduce taxpayer exposure, it could also reduce access to affordable mortgages, especially for low to moderate income households. Feasibility challenges scale and complexity of the modern finance that they're proposing. The US financial system is far more complex than it was in the 1930s. Get a grip. With massive global integration and trillions of dollars in daily transactions, a single agency may struggle to effectively oversee such a large and dynamic system. The disruption, the dismantling. This dismantling existing agencies and creating a new structure would involve significant legal, operational, and political challenges, potentially disrupting financial markets during the transition. The discipline risk, the market discipline relies on the assumption that markets self-regulate effectively. However, historical evidence, the 2008 crisis, shows that unchecked market forces often exacerbate risks rather than mitigate them. Congress, financial institutions, and consumer advocacy groups may strongly oppose, and they will, the NCRC will be all over this, such a sweeping overhaul, making it difficult to implement critical analysis, making it difficult to implement. Is this a good proposition? The proposal reflects legitimate concerns about inefficiencies in the current regulatory system and seeks to encourage competition and innovation. It also aligns with free market principles by reducing government intervention. But there are major risks. The lack of checks and balances and the reliance on the market discipline are significant risks. Markets have historically failed to self regulate during periods of excessive speculation, leading to systemic collapses. The Great Depression is an example, the subprime market failure in 2008. So, eliminating consumer protections like FDIC insurance and specialized oversight from the NCUA could undermine public trust in the financial institutions, destabilizing the very markets this proposal seeks to improve. So while this proposal has its merits in terms of efficiency and cost reduction, its focus on reducing regulation and consolidating authority without adequate safeguards introduces significant risks to the financial stability and consumer confidence and consumer protection. The idea of a streamlined agency may be attractive, but in practice, the lack of institutional checks and balances, the risk of systemic instability, and the erosion of trust outweigh the potential benefits. Any reform should prioritize a balance between efficiency and maintaining robust safeguards to protect the financial system and consumers. My name is Lisa Davis. I am the Trusted Banker. Let me know your thoughts in the comments section. Talk to you soon.